Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark tells us bonds have been going crazy. Gold2020forecast.com's Bo Polny believes it's an exciting time for gold. New York Times bestselling author Marin Katusa says sanctions against Russia have been counterproductive. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy. Welcome to This Week in Money, Ross.
Always a pleasure to be with you.
What's happening in the bond market?
Well, we've gone from an extreme back in January where everyone wanted bonds and they were going through the roof to two sell-offs this year, and it just looks as though we've finished the second one. We've seen the yields on the 10-year bonds go from about 1.65% up to 2.35, so about a 40% increase from where we were in January to where we've got to on Thursday of this week. And it looks as though things are going to pause. We've had, in the last 2 weeks, we've seen a record outflow of money from the high-yield sector. So that would be the JNK and the HYG ETFs that track those high-yield items. And oddly enough, that's at a time when those instruments were actually going flat. The only things that we're seeing really big pressure weren't on the corporate side. They were over on the Treasury side where we saw the hardest break actually happen. So measurements that we do show that relative strength is now at an extreme, so we're probably going to see a pause in the bonds. In terms of the yield, it's retraced about half of the move that we saw to the downside in the previous year. So it's a good spot technically, and to say from a perspective of a panic in the streets for selling, that we'd be looking for a pause here in bonds now.
The U.S. dollar's been on a big charge for the last 2 years. Is it still charging?
That was one we were looking for a top. We were a little bit early in that, but the rollover has occurred. We've dropped from par down to, I guess just about 97 and 93 and change, 7% off the high. The classic here would be that we retraced roughly 40% of the rally from this time last year. So we're within 1 to 2% of that. Be looking for the U.S. dollar, to start to gain a little bit of traction here, find some support. And with that, the Canadian dollar, the other side of the coin, it's had a 7% rally. And we're starting to see overbought readings on the Canadian dollar, similar to what we saw during the bear markets of the early 1980s and the mid-1990s when the Canadian dollar was really having trouble. And we would get interim rallies that would get back to the 50-week average. They'd also retrace percentage of the declines. And that's what we're seeing right now. There's maybe another 1.5 cents in terms of the upside appearance in the Canadian dollar right now, but it looks as though with these type of signals that we're getting, you probably see it roll over within the next, say, 1 to 3 weeks. That would be the norm. That would be the norm that we would see the U.S. dollar basing out over this next 1 to 3 weeks.
Precious metals, how are they doing?
Well, you'd expect with this decline that we've had in the U.S. dollar that we would have had a really good move in precious metals, but it's been fairly subdued. It was a good week for the precious metals. Silver performing decently, gold performing decently, but we're still flirting around the March best levels we saw in March. So they've broken out of a few trend lines. In the short term, they look a little bit on the positive side. Gold sitting in the high 12.15 to 12.20 range. I think it's necessary that it hold at the 1200. Silver's broken out of some pretty good resistance lines coming down for the last number of years. I'd want to see it hold well. It could have maybe a 40-cent pullback, but what we've seen has been pretty muted as far as the strength is right now. The silver has been leading off the bottom, which is good. Since the, third week of April, silver's outperformed gold. We look at the relative strength index on the ratio, that silver to gold ratio, and it's just over 70 right now. If you want to see silver as the leader off the bottom, then have gold take over the leadership, and then the final part of the move, silver once again usually comes into its own. So we'll watch that RSI. If it gets up over 80, that would be a big warning in terms of coming out of any of the precious metals investments, for the traders at least.
Palladium was the big darling last year, making a huge charge. Any players in that?
The palladium has actually had the PGM group, platinum, palladium, has been holding up pretty well in here. The palladium price got a bit of life right now, hasn't broken out per se. The platinum is the one that really interests me in here. I look at some of these oversold readings, and in particular, when we see 9 consecutive periods of pressure in something, and in this case on platinum, that would be 9 consecutive months I'm looking at of downside pressure. We've been seeing some very, very good upside reversals from that in many, many items. Actually, crude oil had that same signal a couple of months ago at the bottom. Well, we've got that in platinum in April. The last time we had it was back in 1997. You don't get this signal very often, and it generally is a precursor to a pretty good rally off the bottom. So the PGM group, platinum group metals, might have some life here right now.
Crude's moved up from the $40 level pretty well, but is it going to continue that?
Getting the first weekly overbought signals right now in the crude. And, that's coming just as you would expect at the same time that the dollar is starting to get into oversold territory off the top. So when we look back, the U.S. dollar and the crude oil, there is a very, very high inverse correlation. There's maybe 90% inverse correlation there. So, and this week, we saw gold, or the crude, fail to have much more strength on the upside. A week ago it was doing very well. Now it's subsided, but that's while the dollar was breaking. So we're showing at this point some relative weakness in crude to what we would have expected with a weak dollar. That to me says oil here at this $59 to $60 level probably pulls back into the mid-50s, and it'll be a matter of how well it holds at that point. But this, at the most, we've got seasonal strength that's starting to wane right here. I wouldn't be surprised to see a pullback.
Ross, thanks a lot for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy. You can contact him by email, ross.clark@cibc.ca. Coming up next on This Week in Money, Bo Polny.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Bo Polny, founder of Gold2020Forecast.com, is on the line from California. Bo, welcome to This Week in Money.
Hi, Jim. Thank you for calling, and nice to talk to you again.
In 2011, you called the gold top at $1,900, the silver top at $49. Last November, you called the second bottom in gold at $1,130 within 48 hours. And then just 2 months ago in the middle of March, you stated gold was making a very important low at $11.45 and the U.S. dollar was about to top. And both events occurred as you forecast. Now, are you calling for a big move in both gold and silver and a crash in the U.S. dollar before summer?
That sounds great. It's a great place to start. Right after we had spoke, Jim, about a week later, I had flown out to Singapore and then to Hong Kong afterwards for 2 gold conferences. And in both conferences, I did a presentation, and I put up a slide for the audience, and the slide included 3 specific items. The first item stated gold and silver bull market breakout starting now, which at that time was the third week, into the and before summer. The second item that we mentioned that was on that slide was a U.S. dollar top arrived March 16th, and that's just after we had spoken. Continued weakness into the end of April, and ending with a breathtaking crash before summer. And the third item on that page was a devastating world market crash starting in 2015 and ending in the year 2016. So those were the three items that we had done at the presentation. At the time of our talk in the middle of March, right at that time, the U.S. dollar was at 100 or just under 100, and right after that it went up to 100.71. That day we emailed our subscribers saying the 100 mark had been hit and gold should be topping. The dollar should be topping at 100, right on the 100 range, and the number ended up being 100.71. And it was kind of funny because when we were in Singapore on stage talking, everybody's like super bullish on the U.S. dollar, and I was specifically saying it's done. And right after that, it started dropping. And since then, it's been quite interesting on the U.S. dollar. It's been down ever since. So that's probably a good place to start. I hope I've answered some of your questions on both the U.S. dollar and gold.
You forecast the U.S. dollar top in March at 100. What do you see for the dollar going forward?
As I mentioned earlier, from the March date, the middle of March, that point forward, the dollar should be dropping, and ever since then, I believe to the U.S. dollar, as I just last checked, is at 93.26. So it's basically down almost 7.5 points, and then a whole 7.5 points from the 100.71 top. So moving forward, I see continued downward pressure, significant pressure on the dollar into and before, specifically before summer. So that would put a dollar bottom before anything even changes would come into, and as you know, if we know what summer is, summer starts on Sunday, June 21st. So so the U.S. dollar should bottom before then. But until that point, it's down.
What about the 10 and 30-year U.S. bonds?
I don't really look at the bonds too closely, but I did, as a favor to a few subscribers, look at the bond cycle, and what I found was kind of amazing. But when I overlaid the bond cycle onto the U.S. dollar, they were almost identical. So are the bonds following the dollar, or is the dollar following the bonds? It's irrelevant because they're both identical. So what that's showing is that the U.S., the treasuries are supposed to get, hit really hard here, into and before summer, my summer point, and I believe that's going to, be one of the main triggers for what we're expecting here for the U.S. dollar, for what we're expecting for gold and for silver. So I hope I've answered your question, but basically the direction for the bonds, the treasuries, is in the same absolute direction that the U.S. dollar is headed into summer.
At the end of April, we did another interview when you stated the Hong Kong HSI index was about to hit for 5 consecutive days, and then the U.S. markets would continue to rise. Starting April 30th, the HSI index fell for 5 days straight, dropping more than 1,100 points. What do you see going forward in the stock markets?
What we talked about on our interview in April was the Hong Kong index had replayed a specific historic cycle pattern, and so right at that point, at the end of April, I was expecting the Hong Kong index to drop for 5 days, and lo and behold, it did exactly that by dropping 1,100 points. Again, the cycles don't give price, but you give the amount of days or what someone should expect. And so the pattern was down, and the down pattern ended up being exactly 1,110 points to the downside in terms of the drop. So that was fun to watch. Again, didn't crash like we were expecting, but again, we weren't overall expecting a massive crash in any of the equities, because as we talked in that April mark, is the stock market itself, the U.S. markets were supposed to have one final rally or one additional leg to the upside before a top comes in. So, so the fact that Hong Kong didn't crash, it's not a problem, because neither did the U.S. markets, and we were not expecting that because we were expecting a down cycle at the beginning of May into the first week. Well, we got that. Exactly even that even happened on the U.S. markets, dropped like 300 or something points. And then since then, the markets have reversed and gone up. So again, so that forecast that we called about a low in May, early May, and then a rise in the markets, that's exactly what's happened, and we're seeing continued follow through, even with yesterday, another 200, almost nearly 200 points up on the Dow. So the stock market cycle continues up, and that's not going to change until our cycle point comes in. But the cycle is still upwards, and it hasn't topped yet. On our webpage, we've even got a bearish wedge laid out, and that shows that that's coming to a near top as well. But again, the stock market cycle is up, and we're not expecting a crash just yet into the markets.
What about real estate prices?
Well, looking at real estate, when the stock market goes, so too will real estate burst, and for the second time for the U.S. and also then London will have it, Asia, Australia, Canada. Most all the world will experience massive problems in terms of real estate. But but if you can look at it from a point of Shemitah and Jubilee, see, mortgages and we're always from a standpoint of Jubilee and sabbatical year or a 7-year cycles. Mortgages are supposed to be 7 years, not 30. And so what ends up happening, I'm guessing that I would say that by the fact that the cycle for the equities and forecasting a crash in the real estate, I will believe because of everything that's been created in terms of monies and the way the monies have been created, and so the way they've been traded should not have been done that way, and that's the reason for a potential crash into the Jubilee or in the Jubilee.
How far back does your stock cycle go?
I've taken the cycle all the way back to the year 1764, and now the Currency Act, and from that year. What I've discovered is, again, the mathematical number 7 multiplied by 3 equals 21. 21, every 21 years, there has been a stock recession or crash that has occurred since then. So it goes back, over 200 years, and the next cycle low is projected for the year 2016. So that cycle, the long-term cycle, going back, over 200 years, is unbroken for an entire, for the 240 years so far, and so it is projecting the low. And then that's a long-term cycle. Then my short-term cycle counts, which would be my day counts and week counts, those are also unbroken, and they also specifically forecast a low coming in 2016. The difference between the two cycles is one gives a gross, like a larger time point. And then the shorter term time points allow me to pinpoint this more of a week, where the low should be coming in. But again, so the cycle goes back that far, and it is pointing to 2016 as a low. And lastly, if somebody is interested in that, they can email me at, I'll give my email address at the end. But they can email me, or at some point, I think by next week, I'll try to get my webmaster to get that posted on my website as well.
What has happened to gold and silver since your March forecast?
That was so. Again, when we were in Singapore and Hong Kong, we had a bullet point from the slide: gold and silver bull market breakout starting now, which was in March into and before summer. So since then, gold came into a cycle low at 1140. When we were speaking specifically, the gold was at 1145. So basically, gold went a day or two more, and it dropped like $4 more, down to 1141. And since then, it's moved up. And currently, gold today is at 1225, so up about $85, sitting at the 200-day simple moving average on the daily charts. Now, the key here to understanding of where we're at with regard to the cycles is gold bottomed at 1130 in November of 2014. Since then, gold has been stuck in an absolute wedge of 4 years, and specifically silver better illustrates this point, It's been stuck in a 4-year wedge, and it's not been able to get out of that wedge for 4 entire years. I've illustrated that wedge and that cycle pattern on the it's on my website, actually. If you went to top of the page, and it's the May 10th update, you can click on it, and it's the last page that comes up on the PDF. But basically what it describes there, and it illustrates pretty clearly, is a descending triangle, or it's a wedge that silver has been stuck in completely for 4 years unbroken. So in November, when we did an interview with Carrie Lutz and then Jim Paplava, Financial Survivors Network, we were basically saying, right at that critical junction point, gold should have bottomed, and within I think 48 hours of that point, it dropped down to 1140. And ever since then, this has been holding as the low. That low has not and will not break at this point in time because the cycle is up. And then in March, that was nothing but a higher degree low, $11 higher. And you're like, oh wow, $11. But it's key because it's a higher degree low. And then just this past week, we wrote in our update, and specifically, in my travels, I've really met some amazing people, one of which, was Bill Murphy, and I was speaking with him this past Monday, and I said, don't be surprised if by Tuesday or Wednesday that wedge breaks. And sure enough, silver rose 60 cents, and it took out the wedge, and it broke it. That 60 cents is critical because it's never gotten through that line in over an entire 4 years until this past Wednesday. And that's why it's important to understand and read what a bullish descending triangle is. And I've written it on my webpage, on that PDF article of May 10th. But let me read it to you here. It says, these types of patterns where the markets get squeezed into the apex can produce very powerful moves in the opposite direction. Why? Because the longer the markets spend down at that lower right-hand corner, the more shorts pile in. Well, go look at the COT reports, for people who look at the COTs. The COT numbers are coming out, I believe today, Friday, and since they post them on Friday. Don't be surprised if there's more shorts. The point is that gold is getting to some critical time, price and time points. First off, we've got the 50-day moving average on the dailies broken. The 100 moving average broken. The 200-day gold is sitting at right now at 1225. That is expected to break next week, okay, by latter part of the week potentially, or shortly thereafter. Now that we're at the 200-day, don't be surprised if we have a final little battle here. So again, as I, even told Mr. Murphy, that don't be surprised if we get a little pullback here into early part of this coming week. And I expect that, in terms of just don't hold me to this, but I will, put out this, again, I'm doing this because I want people who are gold believers, who are protecting, themselves, family, to be on the correct side of the trade. And, every time gold got to 1130 in November, it got to 1141 in March. Everyone's calling for $1,000 gold, and it never came. And the reason it never came because the cycle was up. Okay, the cycle's been up since November, and it doesn't stop. The up cycle does not stop until at least my time point, my gold index time point comes in the month of June, this coming June. So until June, to be on the short side of the trade, hoping for $1,000, you're going to be wrong. Because again, the dollar cycle, the bond cycles are all down. And so those are all going down, gold's going up, and right now gold's just taking out the 50, the 100, soon to take out the 200. When it takes out the 400 and then the 500, it's going to get really exciting. The 500-day moving average has been support for the U.S. For gold priced in U.S. dollars for since 2000, and it broke that in February of 2013, and it's about to reclaim it. So it's going to get really exciting here because these moving averages, once they start breaking, the shorts, as the last sentence says of a bullish descending triangle defined, the shorts scramble to cover. Okay? When you can't hold it down anymore, they have to scramble. And the more shorts that scramble, the more exciting the price projection becomes for gold and for silver here into June. And again, since the Singapore and Hong Kong, and since we actually have spoken, Jim, since March, we've had this forecast out, and we've always written before summer. And again, summer officially starts the 21st of June, and it will be before that time point. And it will be critical to have that time point.
Is gold going to spike at $2,000? Is that possible?
Well, here's the thing. I spoke last year. I made a forecast calling for a $2,000 price. I was early in my forecast, and that was a mistake. As you can see, we've had how many near perfect calls so far with one error. So I think we're batting pretty good, extremely good. I don't think there's one person in the world calling for a dollar top in March, and we did. I don't think everyone was calling for $1,000 gold in November, and we said it's a bottom. So I don't know that missing a $2,000 price point changes anything. But what I just described on breaking a wedge, I want to say this: when you break the wedge, shorts scramble to cover. How high the price goes, cycles do not give me price in terms of cycles. There's other ways that I can look at it in terms of what it could go to. The point is that it's less important the price than the time. And so by knowing when a top could and should arrive, and again, we've got it narrowed down first to a week, then it will end up being to a day. But the point is, when this day arrives, it will be very exciting, regardless of what the price is. So could a large number like that get hit? Sure. It might actually be too small, or it might be too high. But the point is that it's going to be, God knows, but I will tell you, it will be exciting. And that's all I have to say about, some really amazing prices, for gold.
What about a silver spike?
Well, if gold spikes, let me tell you, silver is going to be one heck of a ride, straight vertical. So, my positions are on silver. So, I'm excited to watch gold. I'm really excited about silver.
On your site, you offer a gold index. How does the index benefit a gold investor?
Well, as we talked about earlier, in terms of knowing when. So we talked about a possible pullback. Okay, so if the pullback comes this week, which again, today is the 15th, so we have a pullback early part of this week. Don't be surprised if we get that. If we get that, that'll be a beautiful point. And so what an index will do, it's basically their timing points. My subscribers receive timing points. We got the timing point for November. We got the timing point for March, low. We have a timing point right here, and one of the critical timing points is the June time point. I will not, post that or provide that. That's specifically for subscribers. But the point is that if gold's moving vertical and so is silver, at what point in price do you sell? You see, the index takes away the emotion, and it just gives you a timing point. So you basically wait, just like we knew in March. We waited, just like we're waiting to early part of this week. But the point is, it gives you a timing point to execute it. Something that you if you want to move on that position, or if you know what top is arriving, rather than hoping or guessing, hey, it could be this price, or hey, it could be that price. It's not a guess. It's simply knowing a date and a point in time, and that's what the index provides investors. And I think it's critical for anybody who's invested in gold to know that time point. And so again, I see exciting times ahead. And I think anybody invested in gold and silver should know what are key inflection points and what are key critical tops and bottoms.
How could someone get your free 252-year cycle?
Oh yeah, and that cycle is offered on actually two ways. One, my website, gold2020forecast.com. Within a few days to a week, I should have that posted on there, so you should be able to go on there and download a PDF of that cycle. If you want it sooner, just send me an email. It's the same thing as gold2020forecast, and that'll be at AOL.com. and I will send off that PDF to you. So if you feel free to send me an email if you're interested in the cycle sooner rather than later. If not, you get off my website, sometime next week. So that's, I hope I've answered all your questions, but very exciting time, for the gold investors and scary times for those invested in the stock market, not just yet, but after this top comes in, it's going to be, it's not going to be good.
My guest has been Bo Polny. Thank you very much, Bo, by the way, for being with us.
My pleasure. And again, thank you for calling, and thanks for, for doing this follow-up interview.
And his website is gold2020forecast.com. Coming up next, New York Times bestseller Marin Katusa here on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Marin Katusa, CEO of brand spiking new Katusa Research. He's also the author of The Colder War, a New York Times bestseller. Welcome to This Week in Money, Marin.
Many thanks.
Well, first off, you were the main guy at Casey Research for the past decade. What prompted you to leave Casey Research?
Well, a couple of things. First off, my time at Casey Research was great. It was a great platform for learning. Doug Casey's a legend in the business. He chose me years ago to be his kind of right-hand man. I've learned great amounts from Doug. We've become very close friends personally. I manage his money, and that continues today. Essentially what happened was Casey Research, the owners of Casey Research had, I guess, a difference in direction, and there's a new management team that came in and bought out Casey Research. And Doug Casey, to his credit, did everything he could to, get me on side. But with everything moving forward, I just thought, me and the new management team, we had a different vision on the equity. They're great guys, very smart guys. I've known them for about just 8-9 years about there. And I think they're going to do great things with Casey Research. But I thought where the markets are right now, where I've made all my money in the markets, and it's from equity. And my focus moving forward is going to be private placements. That's where I've made all my money. And just basically using Pareto's law, where we are in the markets today, with my network, my reputation, I think this is the best time to branch out and focus on what my passion and what I believe I'm the best in the world at doing. So that's what my focus is, and still maintain great relationships with Doug and the new management team. Actually, I just flew back from a meeting with them, and I'm very excited about moving forward.
So could you tell us about KatusaResearch.com?
Sure. So what I'm going to be doing is, because I have such a large following from my days at Casey and with my book cracking the New York Times bestseller list, I've got quite a large following. And I've decided to put out all of my thoughts, analysis, and research for free on my website. If people are interested, they could sign up for free. They get to see my stuff. Since I've left Casey Research, I was on the front page of the New York Times. I've been on major media in the U.S., and everyone is so confused and baffled why I would provide, over the last decade, my reputation as some of the best research and original thoughts on the street for free. Because I can. It's fun. And what I'm going to do moving forward is going to surprise a lot of people. I'm adding a new video component on my website, and it's basically letting people have access to in the room, in the deal with myself. I run a very large hedge fund. I'm one of the largest shareholders with Doug Casey and Rick Rule, and my focus is on the funds. That's where I make my money from. And in 2 years, I'm going to start up a new, very large fund. I've got a lot of offers today for new money, but because of the success of our current funds, I want to just finish them up. They have 2 years left on their mandate. And I'm going to let everyone have a feel of what I'm all about and what my research is like in my research team. I've got 5 full-time staff members in my office, and if there's a deal going on in the resource sector, everyone will know that Katusa Research is the first place to find out about it.
How do you make money if you're giving this away for free?
Well, like I stated, I make my money from my hedge funds, and I'll be talking about what I'm doing in my hedge fund, and people can decide what they want to do with that information. But I'm not going to be making any money from my thoughts or analysis on the website. So my money is made from my investments.
Well, let's talk markets here for a while. Oil and natural gas. What do you see long term?
Exactly what I've been saying here earlier, like I've said on your show and in my own newsletters and in the media. About a year ago this time, I started saying how the oil patch is looking shaky. I've been very bearish on natural gas. That's been a right call. I still think we're going to go sideways here. There's a lot of frac log buildup of these phantom oil wells that can come online if oil pops to 70. So I think we're going to be in a trading range between 45 to 65 for the next 12 months.
I guess for the consumer, that's good news.
Well, not really. You see, a lot of people are going, geez, oil's dropped in half. How come the price at the pumps hasn't dropped in half? Or even the U.S. economy, how come it hasn't picked up? Well, because the crack spread, the refineries are basing their prices off the international market, so the Brent crude, which is much higher than the WTI. So even though your investments are not getting the international markets, you're paying international gas prices because of the crack spread with the refineries. And we've seen that the benefit that the decrease in the oil price and then the smaller decrease at the pump for your automobiles, it's been negated by the big loss of investment by these oil companies and the higher salaries and tens of billions of dollars was pumped into the economy because of the bull market in oil. So that hasn't quite translated to the average Joe.
Is there any way for that to happen?
Well, the only way it would happen is if the crack spreads got much more narrow. Now, the crack spread is the differential between what the refinery pays for the input crude versus what they sell it for in the output product, the refined product. And until that changes, it's not going to change.
Yes, because people have asked me, how come gasoline prices are still high when crude oil prices are low? That explains it all.
It's all about the crack spread.
And I said, too, they can charge you pretty well whatever they want at the gasoline pump. There isn't a lot of competition, at least in Canada.
That's right, exactly.
Your thoughts on gold and silver?
Look, I really like gold. One of my favorite sayings is gold is the currency of kings, silver is the currency of gentlemen, barter is the currency of peasants, but debt is the currency of slaves. And we are in a market where interest rates are so low, people are chasing yield. And there's a whole generation out there that don't realize that interest rates could go up. People just expect interest rates to stay low forever. And they're basically positioning their futures into slavery. Debt is the worst thing you could possibly own in a deflation. I don't see hyperinflation anytime soon. But gold, I think, is going to do okay. Do I see it in the next 12 months at 3,000? No. Do I see 1,500? Definitely. Could it go down a bit more? Sure. But I think we're in a trading range of somewhere between 1,100 and 1,400 for the next 12 months.
I did see one research paper that said gold could drop as low as 700, but isn't the price of production around $1,100 an ounce?
Well, it all depends what you calculate, but what you're probably referring to is something called all-in sustaining capex, cost per ounce. And you're right about, across the world it's probably somewhere around $1,100 an ounce. The companies, analysts try to make big shocking statements to get attention to their lists and all sorts of stuff. But $700, if the price of gold gets to $700, buy as much as you can because no company in the world can have a sustaining capex of $700 per ounce. So that's a great buying opportunity. I've learned that anything can happen, so I don't like to say no, it's not possible. But if it did, I would definitely back up the truck at that point.
Your thoughts on the Canadian dollar?
Well, it's exactly what I stated over a year ago. I've been quite bullish on the U.S. dollar, and I think that there's a lot of benefits to the Canadian economy for a weak dollar, not just our manufacturing, but also our mining and resources. The only thing that's keeping our resource sector, buoyant right now in Alberta is the fact that 20% discount to the U.S. dollar makes our products worth more because we're producing at a lower cost internationally, basically vis-a-vis the U.S. cost of the same commodity, but we're selling for the U.S. price. So, for example, a copper producer in BC is making 20% more profits because of the currency hedge. That's a good thing if you're that producer.
Are the junior venture markets in Canada starting to turn up?
Actually, they really are. If you look at some of the financings, we're starting to see some significant interest on the bought deal. Some of the bigger fund managers, as myself, are starting to deploy some capital. And I think we're starting to see some interesting deals. And, have we seen the bottom? I don't know. But the deals are now so lucrative that people are starting to take some serious size.
We're speaking to Marin Katusa, CEO of brand new KatusaResearch.com. Marin, your book, The Colder War, is on the New York Times bestseller list, also on several other papers' bestseller lists, USA Today, for example. What was it like doing the media tour, going across the continent, talking about your book, and what did you find out about the process?
You know what I really found out was, being a Canadian, I wasn't really in tune with the U.S. media. So when you do a publishing agreement like I did with a big group, you have commitments to meet, and they set up all the meetings for you. You basically just jump on a plane, and from 7 o'clock in the morning to basically midnight, you're doing radio, podcast, interviews, radio shows, TV, all sorts of stuff, newsprint. And it was intense. We did 2 weeks of a major media blitz. But the biggest shocker to me was the difference between the Republican and the Democrat news outlets. And depending on where I went, they each had an agenda that they wanted to push. And it wasn't necessarily the reality of what I wanted to talk about, but you always have to bring it back to the reality of the situation. The biggest interesting thing is the day my book went live, essentially Putin made a big splash at the APEC conference. So it couldn't have better timing. I'm sure that helped get it on the New York Times bestseller list. But it was interesting whether you do CNN or CNBC or RT. It really depends on their audience, on what the angle will be. But I had a great time, like walking into the Harvard bookstore and giving a talk at Harvard and seeing your book right beside Henry Kissinger, from basically a kid from East Vancouver. It was kind of a cool thing to experience, and the best part of it is having your first book on the New York Times. The offers I've been getting for my second book have been overwhelming. So stay tuned to that. That's going to probably unfold in the next 12, 18 months, so that'll be pretty interesting.
Maybe tell people what your book's about.
Well, essentially, what the Colder War really is about is how the emerging markets led by Vladimir Putin and the Asian growing tigers, especially China, are working together in unison against the interests of the U.S. internationally. You see the BRIC Bank, you see the new BRIC Bank coming out against the IMF. You see the new, the new EU, the Eurasian Union that Putin's really backstopping. And yes, the price of oil is kind of hurting them, but people have to understand that, next to Norway and Saudi Arabia, Russia's flush with cash. They have much less debt than the Americans. And more importantly, the sanctions against Russia have really pushed the fast-forward button between China and Russia, which is, the last thing the American eagle wants is the Russian bear and the Chinese dragon working together. And that's actually what's happening. So long term, this is very negative for the U.S. markets.
What about the sanctions themselves? I mean, I understand that Canadian and U.S. pork producers are getting hammered because Russia was a major market. The dairy farmers in the Netherlands are getting nailed because their biggest market was Russia. Are these sanctions actually doing anything?
Look, there's always these unintended consequences of sanctions, and they're doing things that they didn't expect. The Germans have lost over 30,000 direct jobs because of the Russians, the sanctions against the Russians. The European Union is starting to get sick and tired of this because, they're depending, even though the price of oil's gone down, they don't have the infrastructure to import, American oil or natural gas yet, and they're depending more on Russian sources of fuel than ever before. And even the Americans, still today, 1 in every 10 homes in America is powered by Russian nuclear fuel. So all these factors play into itself that, the sanctions really aren't working the way people expected them to. And the worst result of the sanctions is the fast-forward button it's put between the Russian and the emerging Asian markets. So would I call it a fail on the American side? I'd call it a C-.
Any chance you think of the sanctions being lifted soon?
No, because the Americans can't allow them to be lifted because it'll basically tell the world that they failed against pushing or stopping Putin's agenda. But do I see, loopholes to the sanctions? Yes. Do I see the European countries kind of laxing on the sanctions? Definitely.
Again, when somebody puts sanctions on, do they ever think the other side's going to retaliate?
Well, exactly. They thought they could create perhaps a revolution in Russia. And what they don't understand is the Russians we hear in the Western media are anti-Putin, no doubt about it. But when you travel to Russia, the average Russian is very pro-Putin. Now, that may be hard for the Western person to understand, but you have to take a look at where the Russians have been in the last 100 years. 9 out of 10 deaths that occurred on the European continent fighting the Nazis, the non-Nazi deaths, were actually from the former Soviet Union. They were a major contributor to the defeat of the Nazis. If you look at what they went through, not just in communism, but at the fall of the Soviet Empire, the average standard of living of the average Russian has increased significantly under Putin's leadership. Now, the Western people will state, yeah, that's because of the price of oil and natural gas. It doesn't matter to the average Russian why that is. All they care about is Vladimir Putin is standing up to NATO, he's standing up to the Americans, and he's giving the Russian people a better standard of living, a better education. The birth rate for the first time in 25 years this year is increasing in Russia. So the demographics are starting to change. And more importantly, they see in the Slavic warrior Vladimir Putin what they believe are the strengths of Russia and of their Slavic people. So the Americans were hoping that there would be a revolution and Putin would really lose his power. The actual opposite has happened. He's become more powerful in Russia because of it.
And I've asked people, too, if you had to rate their international standing, who's done a better job, Putin or President Obama?
That's absolutely an easy, hands-down question. If you look at the Asian markets, you look at the Middle East, Obama's international ratings have decreased significantly from 2009, and Putin's is at all-time highs. So Putin's done a much better job as a global leader.
Maybe the president has to take his shirt off and ride a horse.
Yeah, maybe he's got to get a different PR team. Definitely, Putin's positioned himself as like the next Peter the Great, or Vladimir the Great. In 100 years, they may call him. Who knows? But definitely a very different style of presentation.
Right. Now, if you pulled a stunt like that here, I mean, I heard Putin as well, shoots bears and other animals at his birthday party to show off. If you did that here in the West, what would the result be?
I guess it all depends on the personality. Look at Ralph Klein. He'd probably be able to get away with it, but would a Christy Clark be able to get away with it? No. So I guess it all depends on the individual, but that kind of stuff doesn't really work in at least in Canada. I don't see it working well. In America, who knows what works well there?
How do you see the NDP win in Alberta working out in the oil patch?
Here's my take on it. I think an NDP government in Alberta is probably more conservative than a Liberal government in BC. Okay? And I like Christy Clark. I know her, and, she's a good person. My point here is that the NDP government in Alberta recognize what the bread and butter of Alberta is. It's not tourism. It's not, international business. It's not logistics. It's the oil patch. And the last thing they're going to do is going to bite the hand that feeds them. So I personally think the markets are overreacting on what the NDP is going to do. They were sick and tired of the existing franchise of politicians, and, they made a decision. And the NDP, as a result, won because of that. I think it's in their best interest not to shake things up too much, and I don't expect things to change too much.
Marin, how can people find out more about your company?
Definitely, just come out, Katusa Research, KATUSA Research.com, and you can see all my thoughts, analysis, interviews, all for free on the website.
Marin, best of luck with your new venture.
Many thanks.
That wraps up our show for this week. Thanks to our guests, Ross Clark, Bo Polny, and Marin Katusa, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back again next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.